We have a US economy that is growing slightly below trend. We have Europe, which is sort of muddling along. We still have high debt levels in this world. We have global exports, trade numbers still very weak. We have China weak. We have an overhang of debt and low oil prices in the energy sector. There's just a lot of signs, a lot of trends that are colliding in 2016. And based on the overall numbers, we just don't feel comfortable being extremely overweight on bullish on DM equities at this point in time. You can still find pockets of value. We can see that in Spanish and Italian equities. But overall, the equity market looks quite stretched at these levels.
Yeah, and you've said models such as the United Kingdom and Norway are two that you've pointed out that you say you do not like the model for those as well. But when I look at the UK, it's hard for me to get away from the fact that so many of these are international companies, they're mining companies, they're extraction companies, rather than UK focus. So that's not so much a Brexit call, it's more about the companies, is it?
Exactly, you're absolutely right. It's the predominant exposure to mining companies. We still believe the mining sector is going through a transition phase. It has been going on now for 4 years. There will be more cost cutting, more cuts on the supply side, the production side, as Asia and China is still slowing down. Energy, that's our focus on our Norwegian call. We think overall the energy sector is still on a trajectory downward. We think that could be around 20 to 25% decline in the energy sector. If you look at the valuation, they're still pricing in a rebound in oil prices and profitability. And we just don't see that coming. I mean, there's conflicting of interest in a lot of different oil-producing countries. We don't think Saudi Arabia will lead a coalition to really cut production and see this rebound in oil prices. And you had the Schlumberger CEO out recently this morning saying that we have a cash crisis in the energy sector and defaults are likely to come very soon, and it could be a complete carnage in that sector.
Peter, Bob Parker, good morning to you. I wish I could disagree with you, but I can't. I agree. The tenor of your comment is that the upside in global equity markets is now very limited, with which I completely agree. I think one then has to ask the question, well, what's the downside? And, my thesis is we're probably, in a sideways moving market for at least the rest of this year, if not going into 2017. And, I don't see the grounds for a significant bear market, but I find it very difficult to see where the upside is from here. So that's my first question to you. Do you agree with my comment that it's a sideways moving market? Second question to you is I believe very strongly that at the beginning of this year, emerging markets would start to reverse and outperform developed markets. And I'd be interested in your thoughts on that.
So to your first question, we absolutely agree with that view. We think equities are in a sideways market and it will be for the most of this year. We don't see a lot of catalyst for earnings growth and especially top line growth. It has disappointed for the last 2 earnings seasons and that's holding back. But it's not unusual. We have said many times before in history in equity markets that you have a very long bull market, but then you can have 1 or 2 years in the middle of this cycle where we pause for a year because a lot of things has to readjust in the economy and in various sectors, and I think that's a period that we're going through right now. And coming back to your emerging markets story here, we completely agree. We are sort of leaning towards the view of Templeton, the famous investment management firm, that we are probably looking at a decade opportunity in emerging markets. We're trading at around 12.5 times forward earnings. It's a huge discount to DM equities, and it's actually a historically high spread that we are observing. I think for now the spread is justified given all the headwinds that we are observing in the emerging market countries. But long-term, demographic is better, debt levels are much lower. You have a shift from being focused on extracting natural resources. We're seeing brewing consumer economies in Indonesia, Malaysia. China is moving in that direction. Even South Africa is moving towards being consumer-driven. As we move towards that, I think the valuation gap will narrow and actually eventually get on par. And I think you're absolutely right that I think if you're really a long-term investor, you should be betting and overweighting emerging market equities.